the Guinness Brew Week.
Hetty, can you raise your voice a little?
Sir, can you hear me now? Hello, sir.
Yeah, Hetty, if you can raise your voice a little.
I'm shouting, oh, is it okay?
Yeah, it's a little okay now. Or you can get your device close to your mouth so we can hear you well.
It is on my earpiece is on my mouth direct, and I'm shouting.
Okay. So let's listen to you.
Okay, I said as I was going through the financial position for the Guinness Brewery, I realized something I wasn't very clear about.
Okay, what was that?
Total assets minus total liability. So that will give you what is it profit?
Those giving us interference from background, please can you mute your mic so we can hear Hetty?
Sir, please, I said total assets minus total liability. That will give you profit. Is that it?
That will give you what?
Profit, I'm asking.
No.
Okay, what about the share capital plus income capital will give you what?
Hetty, I think if you can give me a private call, that will be better.
Okay.
After class, you can do so.
Okay, sir. Yeah. I'll do that. Thank you.
Okay, so any other question in addition to Hetty's question before we start today's work? That is based on previous work. Any questions based on previous work? Hey, why no?
Hello.
Hello?
Please, have you projected your screen?
No, I've not shared the screen yet. I'll share very soon. But any question based on last week's work?
Sir.
Yes, I'm listening. Is it Olivia?
Yes, please.
Olivia, if you have a question, please ask. Merinda, your mic is on. Can you put it off?
Please kindly go ahead. I will come in later. Thank you.
Okay. Okay, so let's see what we can do for today. Today we are going to conclude on our financial statement analysis. By looking at what we called capital structure ratios and some investment ratios, then we are okay. It's left with a few things to do. By capital structure ratio, capital structure ratio, we are going to look at what is referred to as gearing. Then we will look at gearing / leverage, financial leverage. They are terms you can use interchangeably. Then we will also look at interest cover ratio. These are the two main ratios we'll be dealing with under financial structure ratios. In some other textbooks, you might even see it as solvency ratios, long-term solvency ratios. They are the same. Let me give the background information about these ratios. You see, from what we did, is it last 2 weeks or last week, on on liquidity ratios. We were trying to gauge the ability of a firm to meet its short-term obligations if those obligations fall due. For example, you have workers to pay. Within a year, you have to pay them. Basically, every month you have to pay them. You have suppliers you have to pay, trade payables. Within a few months, you have to pay them. You might even have some overdraft with some bank that you have to pay within a year. Some few months you have to pay. You have to have money around you. Money in the most liquid form. In the form of cash or cash equivalents that are readily convertible to cash with within a very short time and with ease, so that you can pay them. For example, if you don't even have a cash in your till, but you have some bank account, you can write a check. They are very near cash assets to pay your creditors and your workers. So when we were assessing the liquidity of the company through the liquidity ratios, we were only trying to know how well the company can pay its immediate debts if they fall due. Anyway, let me ask, did we do liquidity ratios? Hello class, did we do liquidity ratios?
No, sir.
We did, right?
No, sir.
No, sir, we didn't do it.
We didn't do liquidity ratios.
Yes, sir.
Yes, sir.
Okay, so let's start from liquidity ratios.
No,
Okay.
sir.
Hello?
Sir, you didn't do liquidity ratio.
Okay, we didn't do liquidity ratios. I was contemplating. Yes.
Efficiency ratio.
So let's start with liquidity ratios. So from what I've been speaking so far, liquidity ratios try to help us understand whether the firm is in the position to pay its immediate debts, to settle its immediate obligations that fall due within 1 year. How well the firm is positioned in meeting those obligations. We gauge the firm's ability to do so using the liquidity ratios. And with liquidity ratios, I'll come back to the capital structure ratios. So let's look at liquidity ratios first. With liquidity ratios, please, you can mute your mic so we don't get the interference. We are going to look at what is called current ratio, and then we will look at what is referred to as acid test ratio. These are the two ratios we'll be looking at under liquidity ratios. Can you please mute your mics? So let's look at current ratio. The current ratio tries to bring head to head our current assets. Current assets are convertible to cash within a short space of time and with some ease. All the elements within the current assets domain, they are convertible to cash readily or convertible to cash within some short space of time without much difficulty. For example, if you have trade receivables, debtors, and you have some amount to pay, you can press on your debtors to get the money and settle your obligations. In that case, you can convert your debtors as a current asset to cash for payment. If you have something like inventory, You can also get inventories sold and realize some cash to settle your obligations. So that's why we are saying they are very near to cash. But the nearness to cash is in some level of degrees. If you have something like cash itself, that it is straight away liquid. That's the ultimate we want. If you have trade receivables, they are more near to cash than inventory, because you might sell the inventory into trade receivables
Sir,
before
please,
you
the
get
following.
the cash back.
Hello, sir.
Yes, question.
Please, it's not a question, but the following people need to mute their mics. Ernest Modestus, Florence Esibu, Infinix Note 2, James Kujo.
Please, all of you who have your mics on, I'm going to send you out of the class, because I don't know how many times I have to be repeating myself about this common thing.
We're joining. We're very sorry, sir.
Okay, thank you. So that is about the current ratio. When we have our current assets, let's match it with our current liabilities, because current ratio is measuring how our current assets, the assets that we can easily convert to cash within a short space of time, how much are those assets compared to the obligations that we have to settle within a year's time. So the matching of the two gives us a sense of whether the company can settle its immediate obligation without paying. So the current ratio is calculated with this formula. It's calculated as current assets, the ratio of current assets to current liabilities. So current assets over current liabilities. Current assets over current liabilities. So you will get something like current assets is to current liabilities. So if your current asset is, let's say, 2 and this is 1, you get 2 is to 1. That's how we express it. It means that your current asset is twice your current liabilities, and therefore your current asset can meet your current obligations 2 times, and that is healthy. If it happens to be something like 1 is to 2, then that is dangerous. It means your current liabilities are twice as larger as your current assets. Your current asset can meet your current obligations only halfway, and that can be dangerous. It means that you can be suffocated as a business. Your creditors can pounce on you, and then you don't have money to pay. And some of them may even threaten taking you to court. You enter into reputational damages. Your business can collapse if you are not liquid. So based on the question we were dealing with, let's try to see how we'll calculate. We are already familiar with this question, and I'm very sure that all of us have gone through the question again. Current ratio, current assets divided by current liabilities. We go to the balance sheet. Our current assets, total current assets is 610 million. The figures are in millions, so you have to be mindful. 610 million. Our current liabilities is our current liabilities is 480. No, let me check. Okay, so our total current liabilities is 480. That is the sum of all our current liabilities, bank overdrafts, trade payables, current tax payable, giving us 480. Then our total liabilities will be our long-term liabilities plus our current liabilities, which will be 680. Then if we add 680 to our total equity, 480, then we get 1,160. Okay, so we know our total current liabilities 480. So when we do our current ratio, it will be equal to current assets of 610 million divided by current liabilities of 480 million. What will the ratio be? Please calculate and give me the results. What will the ratio be?
1.27.
1.27 is to 1. Or you can simply write 1.27, but you have to understand that your current assets is 1.27 against 1 for current liabilities. So this is the ratio between the two figures, current assets and current liabilities. Current asset is 1.27, current liabilities is 1. It means that our current asset can meet our current liabilities without much surplus. It's a little over 1:1. It means we are not too safe, even though all our current liabilities, when converted to cash, can meet all our current liabilities. The strength with which we can use our current assets to meet our current liabilities is not too strong. The strength is weak. There's not that much strength using our current assets to meet our current liabilities. So in your commentary, you will comment about the size of the figure, the size of the ratio, and if you are doing comparative assessment, you also compare to how the company is doing now compared to previously, or this firm is doing compared to a comparable firm, or comparable to the industry average, like we were saying last week. So let's see, 1.27:1. Let's see what the same firm did previously, if we have that ratio. Current ratio, last time or last year they did 1.6:1. So there's a slight 1.6. What are we doing now? 1.27. So we are dipping, we are going down. They did 1.6:1. We are doing approximately 1.3:1, which means we are going down. And you can now go and look at your financial statement again, the balance sheet, and you can see the reason why that is happening. Maybe this year, maybe our liabilities increased over last year, or our current assets are reducing compared to last year. That may be the explanation. But your commentary should be able to capture the fact that the company is going down or doing worse in terms of current ratio this year than last year, and the fact that they need to improve. You can also talk about the things they can do to improve it. That will be very, very informative, and that is a characteristic of an A student. What the company can do. You have identified the problem. You have to suggest some solution to the problem. So let's ask, what can the company do? What are some of the things the company can do to improve the current ratio position? Hello?
Hello, sir.
Yes, sir. Who has, you can raise your hand. There's a place you can click to.
Please, how do you get the 610 over 480?
We picked all those figures from the balance sheet, the statement of financial position. The formula is, the current ratio formula is current assets. That is your total current assets. So this is current assets. Current assets. And this is current liabilities. If you go to your balance sheet, you should have this spreadsheet. It's already on all your platforms. And you should even have solved these questions before the class. When you go to the balance sheet, this is our total current assets. See, our current assets started from here. Inventory, trade, receivables, bank. When you add the three figures, let's see the formula. Yes. When you add these figures, you get your total current liability, 610. Actually, we have millions on top, so 610 million. Divided by our current liabilities. So we go to the lowest part of the balance sheet. This is our current liabilities. Our current liabilities start from bank overdraft, trade payables, current tax payable, giving us total current liabilities of the sum of 10, 430, 40. So when you look at the formula, that is it. And then we have 480 for current liabilities. We want to see how our current liabilities compare with our current assets. How many times our current assets can be used to defray current liabilities. So we did a ratio between them, 610 divided by 480, giving us 1.3 approximately is to 1. So it means our current assets can be used to settle our current liabilities a little over 1 time. So 1 time plus, it is not up to 2 times. It's not up to 2 times. You can settle it only 1 time with a few surplus. Are you okay now? The person who asked the question, are you okay?
Yes, sir. Yes, sir.
Okay, thank you very much. So
Hello,
what we are doing is that this is the current year. This is the current year performance in terms of current ratio. Then the question was requiring us to compare with how the same firm did previously, and then we comment whether the firm is doing well in terms of that ratio or not. So when you go to the lower part of the question, it gives you statistics for last year. And this is current ratio for last year. Current ratio for last year was 1.6 is to 1. 1.6 current assets is to 1 current liability. It means last year we could settle our current liabilities more than 1.5 times, 1.5 times. This year we can't do 1.5 times. So this year we have gone down in terms of that performance. And you may have to comment. And I was asking, once we have identified the problem that the company's current ratio is going down, we should, as our business performance measurement experts, we should be able to suggest what the company can do to improve that situation. And that's the question on the floor. What can the company do? What can this firm do to improve. Yes, Emmanuel.
Please, the company can, pay off some of its current liabilities.
The company can pay some of its current liabilities, right?
Yeah. Yes, please.
Okay, that's what Emmanuel is saying. What would you also say?
Sir,
Elizabeth.
The company should work hard to improve its revenue and then try as much as possible to reduce its liabilities.
Okay. The company can tackle the problem by improving its revenue and its revenue collection from receivables. In fact, what she said is 100% correct. If we are able to sell more beyond what we did last year, all other things being equal, our receivables balance will increase. Our receivable collections in terms of cash or bank will also improve. So if you go to the balance sheet, if we are able to sell more, we will be able to get more of this, more of trade receivables. Possibly we sell on credit. So this figure will increase, and then our bank or cash will also increase. Then we will get a higher total current assets to be in a bigger position to pay our our current liabilities. So that is tackling it from revenue side to improve your current assets. We can also look at the problem from the current liability side to suppress the current liabilities as much as we can. And of course, we can even get the multiplier effect from the solution Queensland gave. If we are selling more and improving on our cash position and maybe our receivables position as well, you will realize that we may not go into the problem of going for bank overdraft. We may not. If we are selling more and we are doing well in our receivables collections, we may have more cash within the firm so that we may not need the overdraft facility. If the overdraft facility is deleted, our current liabilities will go down and it will go to improve our current ratio. Yes, that is it. Basically, these are the main points that you can do to improve the situation. Or someone, yes, Infinix Note 2, you have to give us your name. You are not called Infinix Note 2. Infinix Note 2, let's hear you. I don't know your name. What's your name, please? Infinix Note 2. Okay, Infinix Note 2 doesn't want to talk. So if there is no question, let's move ahead. That's about the current ratio.
Hello, sir.
Yes, Florence.
Yes, sir. Sir, the system over 480. I noticed that the liabilities that you had 680, but when you come to the current ratio 610 over 48, I didn't. I want to know where you get the 610 from.
The 610 is, in fact, that's the same question the first person asked. The 610 is your total current assets. Do you have this sheet before you?
Yes.
Please go through it and go to your asset side, specifically your current asset side. You will see this.
Okay.
Total current assets, 610. It is the sum of the values for all your current assets. Then we did the same for current liabilities. The sum of all the values for your current liabilities gave you 480. Please, are you okay? Florence, is it okay?
Yes.
Okay.
Thank you very much.
Okay. Now, sometimes your inventory, you know, our current assets, our total current asset figure includes inventory, trade receivables, bank, and let's say cash. Sometimes, depending on the industry you operate within, the rate at which you can sell inventory is very, very slow. Inventory turnover is not quick, or you have a high inventory turnover period. Inventory sits in your warehouse for long. And it happens to most manufacturing firms, because manufacturing firms will have to go through the process of manufacturing, which can take days sometimes. I mean, depending on the gadget. They might have to do buying of parts from different companies, getting it assembled, go here before the finished product is ready. That may take some days. It may take some long days. And for that reason, if you are using your inventory as a means of settling your payable or your liability or your creditor who is just knocking on your door to take his money, it may not work smoothly. Someone is knocking on your door to take his money. Then you are now going to buy materials, send it to the factory, buy other components, get it assembled through 3 or 4 processes before it becomes finished good. Then it could even sit in the warehouse for some time before customers come and take it. The person is just knocking on your door. If you don't take it, the person will take you to the police station. So for some industries, inventory may not be liquid enough to be used in settlement of current liabilities. So it will be appropriate to exclude the inventory in trying to gauge your liquidity if you operate in such industries. And that is what gives birth to the other test called asset test ratio. So the asset test ratio is trying to find some super liquid test, super liquid ratio to gauge how stronger you are in terms of your liquidity. So let's see the formula for asset test ratio.
Hello, sir. Hello, sir.
Yes, Irene.
Yes, sir. Looking at the ratio that we stated, we had 1 point.
Irene, I can't hear you. Your voice is breaking.
How did we?
Hello, Irene.
Yes, sir. I was asking a question about the answer that we had. System overall, we had 1.27. And we ratioed it to 1. Where from the 1? Or do you always have to ratio it to 1?
I didn't get the question well, but let me try to answer based on how I understood it. The 1, you see, the ratio is between 2 things: current assets on top and current liabilities below. This first figure refers to this one. This first figure refers to this one, and the second figure refers to the below one. So when you see it like this, the communication is that the ratio between the two is that this is more than 1 time this. So our current asset is bigger. You can even see it from the absolute value. But when you convert it to this ratio, it makes it, you are reducing it down, so it makes it more understandable, straight to the point, than if you're using the absolute figures. From the absolute figures, you can see that 610 is more than 480. So it means that your current assets are more than your current liabilities. So if you're using your current asset to pay your current liabilities, your current asset can pay all your current liabilities plus some surplus. And if you reduce it down to the minimum ratio possible, you get 1.3:1. So our current liability, our current assets is 1.3 times our current liabilities. Are you okay?
Hello, sir.
Yes, Irene.
Yes, the is to one. My problem is with is to one. Does it always have to be one?
Yes, it always has to be one.
Okay, sir. Okay, thank you.
It always
Thank
has
you.
to be one. Yes.
Thank you.
Okay, so asset test ratio, I've already explained, giving you the background theory about this, why this one came into existence. It's because in some industries, your inventory may travel a long time, so it may not be too liquid. If you tell someone who is knocking on your door, taking his money, that you are now going to buy raw materials, send it to factory, the factory will go through like 3 or 4 processes in manufacturing. After that, some components will have to be added, blah blah blah. It may take months before it sits in the warehouse for additional days before a customer comes to pick it. Then the customer also delays payment for, let's say, about 1 to 3 months. Then when you take the money, before you pay the person knocking on your door, the person will not have patience. So for industries where inventories are not too liquid, it takes so much time to create inventories, and it takes so much time for inventory to get sold out. You might want to exclude inventory as part of what you use to pay your current liabilities, so that you settle on those that are easily and quickly convertible to cash. So asset test ratio by formula is equal to total current assets total current assets minus inventory divided by current liabilities. We are only excluding this because we are concluding that this is not too liquid. So it will blur our assessment of liquidity. You might deceive yourself into thinking that, oh, my current ratio is 3:1 or 2:1, only to realize that the rate at which your inventory is convertible to cash is very, very slow. And that's, if you gauge your liquidity by including inventory, you could get into troubles. So that's the reason. If we go to our question, our asset test ratio can be computed as the 610 current assets minus the inventory value. Inventory value was 250. So minus 250 divided by 480. This will be equal to 610 minus 250. What is the value?
0.75.
That's the total, but let's break it down. 610 minus 250 first.
360.
360 divided by 480. Now is equal to
0.75.
75:1. So now our current assets are smaller. It cannot even meet our current liabilities one time. It cannot meet. So this is, if you want to gauge super liquid position of your firm using the asset test ratio, this is your asset test ratio position. It means if you are pressed hard to settle on your highly convertible current assets to pay your current liabilities, it cannot pay all your current liabilities. It can only meet about 75% of your current liabilities. So the remaining 25% cannot be met if you convert all your highly liquid assets. That's what it means. Let's see if our question asks us to do that computation. No, we don't have asset test ratio. We don't have asset test ratio for the previous year. But that is how the asset test ratio should be calculated. So in case you have it in an exam, that's how you calculate it and compare. And then you do your commentary. So that is it for liquidity ratios. Any questions? Liquidity ratios. Okay, now let's go to...
Sir.
Yes, sir.
So, sir, I want to know if in assignment or even exams, you meet some of these questions. Do you always have to interpret your final, even though if you are not asked to do that?
In fact, if you have not been asked, and if you do what has not been asked, the only punishment is that you have wasted your own time. You may not lose any marks. If you are not asked and you think you have time and you want to probably explain things further, no problem. But you have to do these things looking at the time available, because you cannot be doing what is not required of you so that you lose time to do what is required of you. That may not be fruitful. Yeah, but if you think the questions are quite within your range, you can even explain things further, even though they are not required. You can do so. I mean, there is no harm in doing that. But where you don't have much time, what is not required should be skipped.
Thank you.
But at your level, unlike maybe even undergraduate, we have to focus more on the commentary than the calculations themselves. So at your level, doing postgraduate studies, master level, the essence of what we are to do is to equip you with tools to take decisions as managers or quasi-managers. So much of the emphasis will be put on how you interpret the figures and how you provide solutions to what the figures are saying, as opposed to merely computing the figures without understanding them. So you have to read more on the commentary, the explanations, what they speak, because that's what managers you do. As for the computations, most firms are using software, and the software will calculate all of these things for them very perfectly. But when the software generates the output, what does it mean to you as a firm manager? How can you use that information to take decisions to improve your firm?
Where is it?
Who is that? Okay, so that is it. Thank you for the question you asked. Now let's go to...
Thank you, sir.
The capital structure ratios. This tries to give us a sense of our long-term liquidity. What we just finished is short-term liquidity. It tries to give us some sense of our long-term liquidity, how solvent we are, how likely or unlikely are we to fold up as a business, how likely or unlikely are we to collapse, long-term wise. That's the capital structure ratio. If you look at any firm, if you look at Guinness Ghana, the statement I gave you for the assignment, you will realize that apart from the, let me try to make us see it together. Okay, so let's look at the balance sheet, the statement of financial position for Guinness Ghana 2019. This is their published financial statement. Okay, you will see that at the equity and liability side, This total equity is the money that is coming from the shareholders, those who own the company. And it is always the case that, or it is mostly the case that the money that the company needs to finance its operations, its expansions and other things, cannot be contributed by only the shareholders. In most cases, that is the case. That is what brought that arrangement called stock exchanges into existence. So that, yes, this company needs money to expand. It wants to do this. But the shareholders don't have the money. They have done what they can. Can we get some people from somewhere who can give us their monies? And then we pledge them something in return for using their money. So the exchange is an organized market where we can trade for some of these purposes. So you will realize that every typical company, apart from the monies that the shareholders have given to the company to use, the company may need extra money. So you will see some other long-term financiers to the company. So when you come to the liability side, you will see long-term liability. You see non-current liabilities, and it is coming in this form: borrowings. Let's concentrate more on the borrowings. The borrowings may be coming from issuing securities on the exchange in the form of loan notes or debentures. It normally comes in the form of some people giving their money to the company for long years, 30 years plus, in exchange for interest every year, plus repayment of the principal. It can also come in the form of some long-term 5-year bank loan, or a combination of the two. So that's what the borrowings will do. If you go and read the note 17 III, and please, the other time I forgot to emphasize the importance of the notes. On the face of financial statements, most things are aggregated, most things are summarized. Then the breakdowns are shown in the notes. Otherwise, if you have to bring all the details on the face of the financial statements, it will be clumsy and it will not be attractive to read. So we attach note numbers. So if you are talking about borrowings, you see the note number is 17 III. At the tail end, at the end of the financial statement, you see the notes. Then you can refer to note 17 III. You see the breakdown of the borrowings. It might be coming from debenture or loan note plus some bank loans plus some other things. So you get to know exactly what is going on. So these people give their monies to the company in addition to what the shareholders have provided in exchange for fixed interests. And when the company undergoes operations and at the end of the year, these lenders will have to be settled their interest. They have to be paid their interests. And if we have some of the profit or cash left, then the shareholders can get something for themselves. So shareholders are residual recipients. After the company has paid all of its lenders, all of its creditors, all of its debt holders, then if we have some left, then shareholders will get something. Otherwise, they don't get anything. So this is a huge risk for the shareholders. If the company has most of it financed by debt holders, by outside contributors, who will have to be paid fixed interest, and the company happens to be not doing so well in terms of profit, it means that shareholders are at a very high risk. They might not get any return on their investment. Sometimes, if the company revenue and profits are very low, the company may not even be able to pay all the interest. If the company is dealing with a lot of borrowings, the company will not even be able to pay all interest, let alone have something for shareholders. Even if the company is able to pay interest, you will realize that only small amount will be left for distribution to shareholders, and that may not be good for shareholders. So we should be able to gauge how the company's structure looks like and the risks it posed to the company itself and to shareholders. Then we are able to advise or tackle the problem. So we are going to do that gauging through these two ratios, as I've already said. Gearing. Gearing measures the ratio of contribution by shareholders to contribution by outsiders, the ratio between the two contributors. So gearing is equal to contribution by shareholders divided by contribution by lenders, or contribution from borrowing. That's basically what gearing measures. It wants to gauge the ratio between the funds provided by shareholders and the funds provided from borrowings. And then we normally measure it in percentage, so times 100%. And then that gives us a sense of the gearing. We can have two positions for gearing. We can have high gearing or low gearing. When a company has a high gearing, we normally refer to that company as high geared or highly geared. Highly geared or high geared. And the one with a low figure is described as low geared or lowly geared, however you want to describe it. If a company is judged to be high geared, in periods where profits are falling, there is so much risk for the company. I've already explained it. The risk may be that if revenues and profits are falling, your interest payment, because you are dealing with so much borrowing, is already high. So if you don't take care, you cannot even pay your interest, let alone having some left for distribution to shareholders. And if that situation goes on and on and on, most shareholders will sell their shares in the company because they may see the company to be not doing well. There is no point in keeping their investment there, and that may collapse the company. So that's a huge risk for the company as well as the shareholders when the company is high geared and then profits and revenues are not good. But for the same high geared company, if profits and revenues are rising, shareholders tend to benefit big time. That is what we call leverage. Leverage comes from the word lever. All of us know about this thing, right? From physics, our elementary science physics, SSS physics.
Yes.
Lever or fulcrum, I think that's another word. Who remembers something about it? Because this word leverage that I'm going to explain, it comes from that. And if we know these things, it will help us to understand it better. Who can say something about a lever from physics or fulcrum?
Hello?
2 people have raised their hands. Let me see.
Hello?
Derek. Derek, let's hear you.
Yeah. Good.
Hello, Derek, your hand is up. You can talk.
No, first, I wanted to contribute to the first question that you asked.
Which one, please?
The previous one, that's the acid test.
Okay, so you can do that, please.
No, I wanted to contribute, but it's okay.
Okay, it's okay. Okay, so now the question on the floor is what a lever is. Our small understanding of lever from our elementary physics. Yes, Charles.
Hello, sir.
Sir, please, a lever is a simple machine that helps us to do work.
Okay.
It has some parts that helps us to know whether we can do the work easily. For example, it has a load, a pivot, and an effort end. So that if the pivot is between the load and the effort, you know it's easier to do that work.
Okay, thank you, Charles. I think you remember your physics. You remember your physics. So lever is like this. From our physics, elementary physics, lever looks like something like this. Okay, so this is the pivot, and then if you have a very heavy load here, like a stone or something, because of this pivot, because of this fulcrum, you can easily do with this load with the help of this fulcrum. This is the lever system from our elementary physics. And it is from this lever system that we have leverage, the term leverage. So it means that the person who is here is leveraging. He is using the lever to do a work he cannot do. He is using the lever to take an undue advantage. It is from that we coin the word leverage. Leverage. So when a high-geared company who is using so much funds from outside contributors is doing well in revenues and profits, most of those revenues and profits are being created by the monies from the outsiders. So when we pay the outsiders their fixed interest, it can happen that we have so much excess. And that is for the shareholders who have contributed few. They have leveraged the lenders. They have leveraged the outside contributors. Are you okay with that? Are you okay?
Yes, sir.
Yeah, so that is how come that word exists. And then we use this same gearing to measure what they call financial leverage. So gearing or financial leverage in most textbooks are synonymous. But we have to understand that leverage, as I explained, is where the company, a high-geared company, is doing very well. It is doing that very well at the expense of using the money of outside contributors, and it goes to benefit the shareholders. Because the outside contributors, they are only paid fixed amount, regardless of how well the company is doing. If the company doesn't make any money at all, they don't care. The company has to go and borrow and pay them their fixed interest. If the company makes billions and billions and billions of profit, they are still paid that fixed amount. It is never negotiated that because the company is using their money and the company has made so much money, now the fixed interest should be increased. No. So high geared company is good when the company is able to do well in revenues and profits. It goes to benefit the shareholders as well as the company itself. Low geared company is a company that is highly financed by shareholders. Maybe the small amount coming from borrowings. In such a company, if the firm is not doing well, it doesn't pose much risk, like I've already explained. The explanation is the opposite for what I said. Because the interest that we have to pay to the lenders is fixed. And we are dealing with small amount of lenders, small amount. So we pay small amount of interest. So even if the company is not doing well, because we don't pay so much in interest, and it is almost like compulsory to pay, because you don't pay so much of it, the risk is low. But in the same low geared company, if the company is doing so well, if they are doing so well, it's okay. But they are doing so well at the expense of the shareholders' own money. So the shareholders don't have much leverage. The shareholders don't benefit so much from the outsiders. That's the difference between the two. Now the next question is, what level of gearing is acceptable? We don't have any hard and fast answer. It sometimes depends on some factors. For example, the industry that the company is operating in and the volatility in profits within that industry. Some industry happen to be having some stable revenues and profitability. So their business risk overall is very low. In such firms, they can deal with, they can afford to do high gearing a little bit because the volatilities in their revenues and profits is somehow stable. So they can gauge their gearing level from there. In some other firms, the business risk could be very high. The volatilities in revenues and returns can be very high, very seasonal. At one point in time, profits can be high. At other points in time, profits can be extremely low. So it swings like that. In such industries, it is highly risky to do high gearing. If you don't take care, you collapse the company. So that is one of what can be used to gauge whether the gearing the company is dealing with is appropriate or not. Apart from that, for exam purposes, you may be required to compare gearing last period to this period for the same company, gearing between different companies, two comparable companies, gearing between a company and the industry average. You may be also asked to do that and then pass your comments. So let's go to our question and try to do the calculation. So let me write the formula correctly. I gave you the layperson's perspective of the formula. So the formula is quoted as gearing is equal to gearing is equal to interest-bearing borrowings so let me make it interest-bearing Or in some textbooks, you just see it as borrowings. So let me make it like that. I will explain it. Borrowings plus preference dividends divided by capital employed, total capital employed. This is the formula we usually use to gauge the gearing. And borrowings here means all interest-bearing borrowings. In fact, all borrowings bear interest. So we exclude something like trade payables. Trade payables, strictly speaking, is a borrowing, but it doesn't bear interest. When you take goods from your supplier and you negotiate with the supplier to pay in 3 months, it is some form of borrowing from the supplier, but it doesn't bear any interest. You don't pay any interest on that amount you owe the supplier to be paid in 3 months' time. So we don't include that value here. But all interest-bearing borrowings, including bank overdrafts, should be part of this. Then we add preference dividends, because preference dividend behaves as interest to creditors. Preference shareholders are paid fixed amount of dividends, and they should be paid that amount of dividend, that fixed amount of dividend, regardless of the company's performance. Whether the company performs well or not, we pay them. So they behave in all manner as debt holders. They behave in all manner as creditors that we pay interest to. So we add these two, then we compare it with the capital employed. In other words, the capital employed is our total financing or our total funds. What percentage of the capital employed comes from borrowings and preference shares? What percentage of our capital employed comes from outside contributors, aside from the shareholders? That's what we are trying to gauge. So that's the formula, and the formula makes sense. Try to get the sense behind the formula. You don't have to just chew it. Let's go to our question.
Hello, sir.
Yes, sir.
Hello, sir.
Yes, sir.
I was saying that in the explanation you gave us a different view of the formula.
I gave you a different formula.
Yes.
Wow.
Because the capital employed, is that not the contribution from shareholders?
The capital employed is a combination of contribution from shareholders plus contribution from outsiders. That's the total funds available for the company to work with.
Yes, in the explanation you made that the numerator.
Then that's a mistake. Where? Here, right?
Yes.
Yes. So contribution by, no, this is a formula. So gearing is contribution by outsiders, let's put it that way, divided by contribution from shareholders plus contribution from outsiders. The second formula I wrote is the same as this one. When you put the contribution from outsiders, when you add it to the contribution from the shareholders, it gives you the capital employed, the capital that the company, the total capital the company is using. Then we want to know the percentage of these total funds available that is coming from outside contributors. That is a measure of our gearing. So that is the same as what I wrote. I don't even know where I wrote that thing. Okay, sorry. That's the same as, yes, writing this. That's the same as saying that gearing is equal to borrowings. These are funds coming from outsiders plus preference shares. They are all seen as funds coming from outsiders because preference shareholders are not ordinary shareholders. Divided by funds coming from both outsiders and shareholders. That is the capital employed. Times 100%. So this gives us a measure of the percentage of this total coming from the outsiders. Okay. Thank you very much for that clarification. Now let's go to our question and see how we can calculate gearing. Gearing was not in the question, so we will not be able to compare with previous year's performance, but we can calculate for this current year. So let's see, capital employed, we can easily calculate it. Capital employed, that is the denominator, is equal to total assets minus current liabilities. That's the usual measure we use. So capital employed is equal to total asset of 1,160 minus current liabilities of 480. This gives us what figure? What does this give us, please? Hello?
680.
680.
What?
680.
I can't hear you, please.
680. 680.
680, good. 680. So that's our capital employed. And then we need a numerator. The numerator is borrowings plus preference dividends. So let's go to our liability side and see all our interest bearing borrowings. Mary, you are talking but I can't hear you. Your link is very weak. So let me go ahead. We have 8% loan notes. 8% alone should tell you this is interest bearing. The interest rate is 8% per annum. 200. Then bank overdraft bears interest. So we have to add that one. Trade payables does not bear any interest. Current tax payable, it doesn't bear any interest. So strictly speaking, our interest bearing borrowings or liabilities per this question will be this 200 plus this 10 plus preference dividends. The question gave no information regarding preference dividends. It means that the company does not deal with preference shares. So we'll have our interest bearing borrowings. To be equal to 200 plus 10, 210. Now our gearing can be measured as interest bearing borrowings 210 divided by the capital employed, the total capital 680 times 100%. So what would that figure be?
0.31%.
Convert it to percentage.
Hey, sorry, 31%.
31%. Good.
Percent.
Approximately 31%.
Yes, sir.
Yes.
So that's the gearing. It means that the percentage of the funds that the company is using to work that comes from outside contributors is 31%. So we have the remaining percentage coming from the shareholders. The remaining percentage will be what? 69, right?
Yes.
Yes, sir.
Yeah, so 69%. So this company is not highly geared. Normally, the high geared companies having to have the opposite of this structure. They have their capital structure where shareholders' equity compared to borrowings is smaller. So the borrowings are bigger. So they can have something like this. Let's go to this financial statement. Total shareholders' equity is 480. Then the borrowings, the interest-bearing borrowings that we calculated to be 610, might be about maybe 610. So if you compare 610 to 480, you will see that the higher percentage of the total funds is coming from outside contributors. That is a high-geared company. Here, this company is not high-geared. It is low-geared. But low-geared is on a scale, because we can get someone with a gearing percentage of, let's say, 10%. It is also low-geared, so they are measured on a scale. We have low-geared but more lower than others. High-geared but more higher than others. Yeah, but that is how the gauging is done. So if you look at this company, gearing of 31%. As it stands, there is little you can say about it in terms of whether it's a good figure or not, unless you have other information. Information like the industry that the company is operating within and the kind of risk that is embedded in that industry. Is it a volatile industry? There are swings, huge swings in profitability and revenues. In that case, it will give you a sense of whether even the 31% gearing is high or not. Or is a very stable industry, profits and revenues are quite stable and they even increase. In that case, you get the sense of knowing whether the 31% is a good figure or it is not a good figure. Apart from the industry issues, the question may give you comparable figures, maybe previous year's figures or industry average figures. Then you compare and make your commentary whether it is improving or it is not improving. But basically, this is what gearing or leverage is about. Any questions on that?
Hello, sir.
Yes, Hetty.
Sir, please, the gearing, is there any baseline?
Hetty, who can say I'm into you?
Hello, sir.
Yes.
Sir, please, I'm asking the gearing, is there any baseline? For instance, if it is below 50%, it is low gearing, or if it is above 50%?
Yeah. In some textbooks, you might find some of those explanations, because you see the midpoint is 50. 50% contribution from shareholders, 50% contribution from outsiders. That is the midpoint where you can say the company is neither high geared nor low geared. It is in between the two. That is on the surface, because the figure alone is not enough for you to say you are high geared or low geared. I was explaining the industry dynamics. You can be having a gearing ratio of less than 50, which on the face of things you might conclude like this company is low geared. But if you bring in the industry dynamics, that company might be very high geared. Yes, so the interpretation should go beyond just the percentages between the shareholders and the outsiders. You have to also take into account the volatility in the industry that the company is operating in. And in most exams, you also have to take into account how the company has done previous years, or how the company compares with the whole industry average. Yeah, but on the face of things, 30% below 50% is low geared, and above 50% is high geared. But I am adding that those figures themselves are not conclusive. you have to also know the dynamics in the industry that the company with those figures are operating. They will have something to say about the figures as well. Okay, so that is gearing. Then the last ratio we'll talk about in connection with capital structure is interest cover. Because one of the biggest things we are looking at when it comes to capital structure, apart from gearing, is also interest payment. If you have most of your financing from borrowings, it means that you will pay so much in interest, also called finance charges. If you have almost all of your financing from shareholders, you will pay almost no interest. Okay, so your gearing goes also with the interest cover ratio. Interest cover tries to help us gauge how much the profit we make, how many times it can pay our interest. Then it gives us a sense of how stronger we are in terms of meeting our interest payment obligation. That's interest cover. How many times can the profit the business generates pay our interest? So the formula is simply profit before interest and tax divided by interest payment. Then you get to know how many times. So it's done the same way as we did for the current ratio. The ratio, this is to that. So if you get 2:1, it means your profit before interest and tax can pay your interest 2 times. The more the ratio is, or the higher the ratio, the better. So interest cover. Sorry. Profit before interest and tax, or earnings before interest and tax, divided by interest payments. So for our question, profit before interest and tax can be taken from the income statement. Profit, this is profit before tax, but after interest. So profit before interest and tax will be this figure, 200, plus the interest we have charged, 20. So it will be 220. I think last week we explained this. So profit before interest and tax is 220 million. And our interest payment, let's go. Interest payment is also referred to as finance charges. So let's go to, yes, we can find it in our income statement. Finance charges is 20. So 220 divided by 20. What's the figure?
It's 11.
11:1. So our profit before interest and tax can pay our interest charges 11 times, which is very strong, very powerful. So we don't have much problem with paying our interest. And shareholders will not be at much risk. The company can pay interest and there will be excess of money to be distributed to shareholders. Excess of profit to be distributed to shareholders. And the low interest or finance charges is coming from the fact that if you look at the company's financial structure, it is not high geared. We have only 31% of the financing from interest-bearing borrowings. So we pay only interest on this 200, and even though we don't know the interest on the overdraft, let's do 8% on 200. 8% times 200, what is the figure? Hello class, 8% times 200. 0.08 times 200. What's the figure?
16.
Sir, 16.
16. Right.
Yes, sir.
So
16,
annual interest payments on this loan that the company took is 16 million, plus maybe some interest they pay on overdrafts, which will be around 4. So it takes the whole of it to 20. That's the meaning of the 20 here. That's the meaning of the 20. Finance charges 20 here. So overall, the company is dealing with smaller amount of borrowings and therefore smaller amount of interest payment. So interest cover is as high as 11 times. That's the meaning of interest cover and how it is calculated. So that is it for financial structure ratios, gearing, and interest cover. Now let's do some selected investment ratios. We have quite a number of investment ratios, but we'll do some selected few.
Hello, sir.
Yes, madam.
Please, the one, how do we get the one?
The one is always there.
The one? Okay, okay.
Yes.
Thank you.
Or in fact, in some books, they will drop the one, but the full meaning is that it is 11 for the profit before interest and tax, and 1 for this. We are trying to divide this. I don't even know the English to use. We have this 20 already, okay? We want to see how many 20s are within this. How many 20s are within 220? There are 11 20s within 220. So because we are comparing this to this is pegged at 1. 1 is total ratio, or 100% if you are dealing with percentages. You get it?
Yes, sir, please.
So we are trying to gauge this one using this one as the base. That is one. This one is gauged as 1. So this is 11 times this. 11 is to 1. Or we have 11 20s inside 220.
Thank you.
That's the meaning, yeah. So investment ratios, quite a number of them, but we are going to select a few of them and talk about. We are going to talk about return on shareholders fund, also known as return on shareholders equity. We will talk about dividend cover, very similar in calculation to the interest cover, dividend cover. How many times the profit we have paid. This time around with the dividend cover, we are looking at things from the shareholders' perspective. With the interest cover, we were looking at things from the outside lender's perspective. How many times the profits the company has generated can pay the dividend we pay to the shareholders. So that's the dividend cover. We have dividend yield. I think I'll talk about these three. We have earnings yield, we have earnings per share, we have price earnings ratio, but I'll talk about some of them. The rest will be easy to read. They are all in the books I sent you, so you can read on them. Let's talk about returns on shareholders fund. Return on shareholders fund. We know the shareholders fund, right? That is the money the shareholders have pledged to the company, given to the company for the company to work with. Only the money coming from the shareholders. What returns are their monies invested bringing? And this is how we calculate it. And remember that all of these things we are doing are estimations. They are not absolute. So even if you calculate and it shows very beautiful statistics, it doesn't mean that is what is going to happen in reality. We are just gauging them. Return on shareholders fund. you can use this shortcut. Very similar in many things with return on capital employed. They are very similar in many things. This one is equal to profit before interest and tax. Profit before interest and tax divided by shareholders fund or total equity. Shareholders fund is straightforward. For our question, profit before interest and tax is calculated as 220 divided by shareholders fund. Let's go to the balance sheet. Shareholders fund, which is also known as total equity, is 480. Is 480. So if we divide the profits the company gets by the shareholders fund 480, then we get a measure of, can multiply it by 100 to get it in percentage. Then we get a measure of the return on shareholders equity. That gives us what? 220 by 480 times 100%.
It's 45.8%.
Is that correct?
Yes, sir.
5.8%.
Is this correct?
Yes, sir.
Okay.
Yes, sir.
So 45.8% approximately. That is the return on shareholders fund. So roughly speaking, it's saying that given the way the company is performing, a rough gauge of how well shareholders' money are contributing to the company's profit is about 46%. So the employment of the shareholders' money, it is yielding a return of about 46%. That's the meaning. That's the rough meaning. Then whether this figure is a good figure or not, we do it the ways that we've been doing them. We compare with previous performance, we compare with industry average, and then we can make a commentary. Let's see whether this question we had something to compare with. I think there's nothing like that. Yeah. But that is how it is computed, return on shareholders equity or shareholders fund. And that's the meaning. And this computation or this formula, where is the figure? Return on shareholders fund. This formula, profit before interest and tax divided by shareholders fund. Is on the assumption that the company does not deal with preference shares, so there is no preference dividend. If there is preference shares, it means the company have to Let me explain this well. Shareholders are residual recipients of profit. So using profit before interest and tax to gauge return on shareholders fund could be misleading. Shareholders are residual recipients of any profit that a company will make. So shareholders get returns after we have paid lenders and after we have paid preference shareholders. So the correct formula is to use the residual profit if you are dealing with ordinary shareholders. So this is for ordinary shareholders. Sorry for that. So it should be profit after, not before, profit after interest, tax, and preference dividend, because ordinary shareholders are residual recipients after all of these people have been paid, after interest has been paid, after tax has been paid, after preference dividends have been paid. If there is anything remaining, then they get something. So a measure of return on their investment should use such a figure. So that is the final profit. Profit after interest, preference dividends, and tax divided by shareholders' equity. So let's remeasure it. If you go to our income statement, the profit after interest, after preference dividends, after tax is stated as 150. It's stated as 150. So if we had preference shares, if the company was dealing with preference shares, we would have had to take, so this is, this is 150. If the company was dealing with preference shares, we would have had to take the preference dividends. Then we get profit after interest, after preference dividends, after tax. Then we divide it by, but here it is 0. We divide it by shareholders' equity. Shareholders' equity of 480 times 100%. So this is a realistic measure of shareholders' a return on shareholders fund. The previous one will be adulterated. It will not be too correct. So what will this figure give us? 150 divided by what?
31.25%.
So 31 point, let's say 3%. Good. So this is a more realistic figure than the previous one. So that is return on shareholders fund. Let's do interest, ordinary dividend cover. Once we know how to calculate interest cover, we should be able to easily calculate dividend cover, ordinary dividend cover. It is the profits after interest, preference dividend, and tax divided by ordinary dividend for the year. Then it is gauging how many times the profits available for the shareholders can pay the dividend we pay to the shareholders. So ordinary, or simply dividend cover. But we add the word ordinary because we are talking about ordinary shareholders. So ordinary dividend cover. Ordinary dividend cover. The formula is. No. The formula is profit after interest comma, preference dividend, comma, tax, divided by dividend, ordinary dividend, because we could have preference dividend. So ordinary dividend payment. That is the measure of ordinary dividend cover. In our question, the question didn't have much information. I don't think we have information on the ordinary dividend payment for the shareholders. But let's see. Okay, dividend paid during the year amounted to 90 million. So we have information on dividend payment. Note 4. Dividend payment is 90 million. So if we divide the profit after interest payment, preference dividend payment, and tax payment, which took us to 150. So the profit after all that was 150. If we divide it by 90, that is the dividend payment in the year, then we get to know how many times this profit can pay this. How many 90s are inside the 150? So what is this figure? 150 by 90.
1.66.
1.66.
Yes, sir.
So let's say about 1.7 is to 1. So the final profit can pay dividend more than one time. Pay dividend plus some surplus remaining. Can pay the dividend 90 plus some surplus remaining. It is not too strong a figure, but that's what it is. If we had a comparable figure, then we could have compared and see what the company is doing. So that's interest cover. That's dividend cover. Yes, we have a comparable figure. The previous year they did 2 times. This year we are doing less than 2 times, only 1.7 times. Okay, so it's normally put in times. So 1.7 times. If you write it 1.7 is to 1, there is no problem with that because it's a ratio. So 2 times dividend cover, ordinary dividend cover. Previous year is 2 times. We are going down. The explanation might be because our profits compared to previous year is also going down. Or
Sir, please.
maybe,
Sir, please, a question.
Yes, question. I'm listening.
Sir, it says 1.7 times. Can't we round the 7 to be 1 and add it to the 2?
You can, but it depends on. Okay, this one they use a rounded figure, so possibly it could have been 1 point some figure and they rounded it to 2. Yes, but
okay.
You have to know exactly what is happening. Whether this was absolutely 2 and this is 1.7, then 2 is not the same as 1.7. So if you round 1.7 to 2, it means you are just forcing things up. Maybe this was 2, exactly 2 times, and this is less than 2 times. So you have to make it stand like that and interpret that we are doing a little worse than previously. Previous was 2 times, we are doing less than 2 times. And sometimes if you go through the financial statements, you can see why it is happening. So if you have information about previous year's profitability, you might see that maybe previous year they did better in profitability than this year. So the figure 150 for previous year was higher, and this year is lower at 150. Or the problem was here, dividend. Maybe previous year they declared a lower dividend. Because if this figure is low, if this figure goes down, the whole ratio will rise. So let's say let's do 80 and see. 150 divided by, let's say, 70. What will the ratio be?
2.14.
2.14. Okay.
Yeah.
So if last year maybe they declared and paid a lower dividend, that may explain the reason why they got a dividend cover of 2. And if this year we are paying a higher dividend, it might not necessarily be that the company is not doing well in profit. It might be that maybe this year we declared a higher level of dividend. So these are some of the possible explanations. So you read through the question well, and you will see what the reason could be. Let's read note 4. During dividend paid during the year ended 31st December 2019 amounted to 90 million, maintaining the same dividend paid in 2018. So the reason is not coming from the dividend side. Last year they paid 90, this year they have paid 90. So the reason is coming from the numerator. It means last year they did better in profit than this year. So if you are commenting on how they can improve this ratio, you only say they have to try to improve their revenue generation, sell more, and so on and so forth. Okay. So that is dividend cover. And let's talk about dividend yield.
Sir.
Yes, sir.
Sir, please, can you go over the ordinary dividend cover again for me?
Please, can you speak out a little?
Sir, can you please go over the ordinary dividend cover again for me?
Okay, the ordinary dividend cover. It's basically saying how many times the profit, the final profit, how many times can it cover our dividend payment? That's the meaning inside the cover. How many times can the profit the company has generated, the final profit, available for distribution to the ordinary shareholders? How many times can it cover the interest payment, the dividend payment? And the formula is simply the profit available for distribution to shareholders divided by dividend payment. The profit available for distribution to shareholders is profit after interest payment, after preference dividend payment, and after tax, divided by the dividend payment. Then we will know how many times that profit available for distribution to shareholders can cover the interest of 90 that we pay them. And from the question we are dealing with, it is 150. That is the profit available for distribution to the ordinary shareholders, divided by interest payment of 90, which gave us 1.7. So our profits available for distribution to shareholders can cover the dividend 1.7 times, less than 2 times the previous year performance. Are you okay?
Yes, sir. Thank you.
I was saying something about the possible reason why the ratio is going down. It can be from the denominator side, because maybe this year we are paying more dividend, a higher dividend. But for this particular question, it is not so, because the question clarified that the 90 they paid this year, they paid the same 90 last year. So the only reason can come from the numerator. It means this year we are doing worse in our final profit than the previous year. Is that okay? I hope that is okay.
Yes, sir.
Okay.
Thank you.
So let's talk about dividend yield, and then I'll end with the investment ratios here. The dividend yield is given in formula as, let me give the formula then I explain. dividend yield. It is given in formula as dividend per share divided by market price per share. And this market price per share figure, you cannot find it on the face of the financial statement, so you have to look at the note if they provided it. This is the meaning. Shareholders pay for the shares, or they buy the shares at a certain price, and their willingness to pay a certain price for a certain share is dependent on how much returns they will make, how much dividend they will make. So a measure of how the price that they have paid for a share is better for the dividend that it will be paid on that share is done through the dividend yield. That's tentatively what we are trying to gauge. Is it worth paying for the share at that price given the dividend that it pays, that share pays? That's the dividend yield. And it's given as a dividend, so we calculate it on a unit level basis. Dividend for one share divided by market price for one share. So the total dividend of 90 divided by the total shares. And that information should be given in the question for you to do that. Then you get a dividend per share. The market price per share. Either they give you total shares available and then the total market capitalization. Then you can do the ratio to get the market price per share, or they will give the market price per share straight away to you. Let's look at this question. The dividend per share. Okay, we have the market price of the company's share throughout the year averaged 3.75 Ghana cedis. So we have information on the market price per share. Sampa company receives 120 million from this. Okay, no, that's not about it. The total number of shares in issue is 400. So this is the total number of shares. So dividend per share, you got a formula: dividend per share over market price per share. Dividend per share is equal to total dividend 90 divided by total number of shares 400. So this is actually 90 million divided by 400. You have the millions on top. So this is equal to what?
0.225.
0.225. Okay, let's write as he has said 0.225. So that is the dividend per share divided by market price per share, which is 3.75. I think that's what they said, 3.75. Let's see. Note 2, 3.75. So when we do the 2, what do we get? 0.225 divided by 3.75.
0.06.
0.06. So let's see. Let me see what it was in the previous year. Okay, so 0.06. Let's convert it to percentage as the comparable year is. Okay, so times 100% will give us
6%.
6%, approximately 6%. And the previous year they did 3.75%. I guess our figures could be wrong. Let's do it. Let's do this one fully. Because this 90 is 90 million. And the 400 is not 400 million. It is just 400. So I think this figure is not correct. So let's do 90, 123 divided by 400. What would that figure be? Because the dividend payment is 90 million. It is not 90. This is what?
225,000.
225,000 divided by, okay, that's divided by 400. Wow.
Yeah. So it is now 225 divided by 3.75.
It will be a huge 3.75. It's still a very big figure.
60,000.
$60,000. Thank you.
So it means the information on the, I'll find more about the information on the share, the number of shares. The number of shares being 400 and the dividend 90 million. Yeah, it makes these two figures some way. But let's assume that it is 90. So the dividend yield, the formula is the most important. Let's forget about the mistakes in the figures. The dividend yield is the dividend per share, which is this dividend payment, 90 million divided by the number of shares. That figure is somehow wrong because the figure is too high. If you use the 90, let's assume it is absolute figure 90. Yes, it will be 90 because this figure reported here will assume that we have the millions on top. So it will use the 90. So the calculation we did previously is likely to be right. So 90 divided by 400, that gave us about 225, yes. 225. Divided by the market price
3.75.
So we got approximately 6%. So the 6% is correct.
Yes, sir.
So if you compare 6% dividend yield to the previous year dividend yield of 3.75%, then this year is doing better. But we have to understand the reason why we are doing better. Yeah, Derek.
Yes, sir. I'm concerned about.
Derek, can you raise your voice a little?
Okay. So if you look at the market price per share, that one is not in millions. So if we use the 19 or the 90 million, I think there's a problem with the figures. So I don't think it's appropriate to use 90 rather.
Okay. So what should be used?
No, it's like the market price per share is not in millions. It is just an exact figure. That's 3.75
sure.
Ghana cedis.
That is the price we pay for one share.
Thank you very much.
Yes.
So if you are using the 90 million over the 400, then that should be the exact figure. But using the 90 million, we have ignored the million.
Yes, and I said that we have to ignore the million. If you look at the way the figures were reported, the millions are on top, right?
Yes.
The millions are on top. So if it is assumed that the same style is adopted for the company's financial reporting, so the previous year 2018, the millions were on top. So the calculation of this dividend yield, that gave us 3.75%. The dividend per share was a certain figure which had millions on top. Like we have 90 million, so 90 million on top. So that is why I concluded that, because I was thinking that because this is 90, then it's 90 million divided by 400. But it is more likely that the millions are on top and they pick the 90. That's how come they got this figure. So if you use the 90, assuming a million on top, then it will be 90. Yes, please.
Yes, but I think that it's the number of shares rather. Looking at the strength of the financial statement, they are all in millions. And looking at the
number of shares being just 400.
Yes, how the it's just 400.
That number is suspicious.
But that, it should be more than 400.
Yes,
because
that number is suspicious. But for the sake of figures and calculation, let's do it as a test. So it means that even if it is 400 or if it is 400,000 or 400 million, it doesn't really matter. The calculation is dividend per share is the total dividend divided by the total number of shares, whether it is 400 or 4,000 or 400 million. You get that figure, you divide it by the market price per share. We get the dividend yield, and then we compare it to the previous year. I'll check this figure. I think it should be more than 400. But even if it is 400, that is what our calculations are yielding. This year is 6% dividend yield compared to previous year 3.75. Company happens to be doing well this year, but we can find reasons that can account for the doing well. And normally you can get those reasons from the parameters of the formula. Dividend per share. So dividend per share may be increasing, maybe better than the previous year. That is why maybe the ratio is high. Or the market price per share this year is lower. Is lower, may not be good overall for the company, but it is accounting for the improvement in the 6% dividend yield. So that's where the reasons may come from. Whatever the figures are, in an actual examination, even if you are given these wrong figures, that's how you will calculate and interpret them. The understanding is the most important thing. How the formula is, how the computation is done, and the reasoning behind the computation, what the computation helps us to gauge from the company. That's the most important thing. Okay. Any questions? Any questions on the investment ratios? I think I'll end here with the investment ratios for now. We are a little behind time. We have a lot to cover. So let me end here with these investment ratios. Anyway, the ones I have not taught you can read on them, and I may not examine you on what I have not taught you.
Hello, sir.
Hello.
Yes, sir.
A lot of interferences. Please, can you control the noise?
Hello.
Yes, sir. Who is speaking now? Is it Fred?
Yes, please.
Fred, I said, you are not close to your device. Your voice is far away. Can you get closer?
Okay. Can you hear me now?
Yes, it's better now.
I think we are dealing with ratios.
Yes, sir.
And when you look at the question that is on the screen, under the notes, you see required. And then it is saying that calculate ratios. I will not read all the sentences, but it says calculate ratios. Now, in exams, are we going to go all over, calculate all these ratios, or they will be very specific?
You are talking about the assignment, right?
No, I'm talking about this particular one.
This particular question. Okay. In most examinations, you know, examinations can differ a little bit between themselves, but in most examinations, you will be asked to calculate some selected ratios. It may not be all the ratios we have looked at from day one till now. For example, if you look at this question, this is a typical exam question. It is a past exam question I modified slightly. If you look at this question, look at the ratios they gave you. They ask you to calculate return on capital employed, net asset turnover, gross profit margin, net profit margin, current ratio, closing inventory holding period, trade receivables collection period, trade payables payment period, dividend yield, dividend cover. They have already calculated this for the previous year, and you are supposed to calculate the equivalent for this year, and then compare and comment on the performance of the company. If you look at the number of ratios we are supposed to calculate, I think there will be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, about 11 ratios. Calculation of the ratios, these 11 ratios, should take you a maximum of 10 minutes. The ratio calculation is not a job. And in fact, it is not. We are not testing any of your intellectual ability when you are asked to calculate the ratios. Because these ratios, if you teach these calculations, these ratio calculations to an SHS student or even a GHS, upper GHS student who is a little good in figures, he can calculate all of them correctly. What will be different from you as a graduate and a manager is what these figures communicate about a business, what these figures make us know about the performance of a business, and how we can improve the situation of the business. That is what will be required of you, that will not be required of the lower person. So you calculating the ratios, you have done nothing yet. So regardless of the number involved in the ratio calculation, at your level of learning, that is never a job. That is never a job. And in a typical examination, to reduce the work, to reduce the calculations, it may be similar to what we are dealing with now. That's why I brought an examination question which can give us a sense of what may be required of us in the exam. You see the structure of this question. They have given you comparable figures, and you are calculating for the same figures in this year and compare and comment. That's the nature that it may take in the exam. Either it will be that same company's previous year statistics, or a comparable company statistics, or industry average statistics that you have to compare. That's how it will be like. So there are not many. Please don't see them as many. They are okay. Because Fred, let me ask. I know you are a manager, or assuming you are a manager, and you want to know the performance of your own firm. Oh, someone is interfering. Please mute your mics, I beg you. Fred, assuming you are a business manager and you want to know the performance of your own firm through these financial statement analysis we are doing, I'm not sure you will say that, oh, the ratios are many, so I'm going to compute 3 ratios and judge my firm's performance on these 3 ratios, even though there are other remaining ratios that can make you know some aspects of your firm's performance. Because there are many, you will not calculate them. I don't think that's the approach you will take. So as many ratios as can help you know exactly how your company is performing, that is what you will do. That shouldn't be a problem at your level of learning now. Thank you. Any other question?
Thank you, sir.
Yes, sir. Florence.
Hello, sir.
Yeah, Florence.
Hello, sir. Yeah, I want to find out whether the question we are solving is in your book.
Whether the question we are solving is what?
It's in your book, the book that you sell to us.
In fact,
I don't have one. That is why I want to find out.
You know, I gave you, apart from the hard copy book that we have copies with Raymond,
Be patient.
I also posted some textbook on financial statement analysis on your platforms. The same question is not in the book, but the same question is in this spreadsheet that I have shared with you. I've shared a spreadsheet on your platforms with you since last week, or even more.
Okay.
Yeah, so the same question has been available to all of you more than a week now. And you will find very similar, very beautiful question in that textbook that I gave you. That textbook, let me see if I have it here. No, I don't have it here. You have that textbook, Accounting in a Nutshell. All the topics you have dealt with now, they are beautifully described, treated there with a lot of examples and trial questions.
Okay.
You are a good student to follow along and be reading. Don't just have it, read it. It's one thing having it and then an entirely different thing reading it.
Okay.
Read it and solve the exam-like questions there. It will help you. And this same question, I have uploaded the spreadsheet, so you have this same question. You can also go over the questions again.
Okay, thank you.
Yeah, Benjamin.
Yes, sir, I have a little concern.
Okay, Ben.
You know,
Ben, can you raise your voice a little?
Where I am, I have a problem with network. But I'm just saying that, you know, where I am, I have a bad network. But I've come to UCC campus today. I'm still experiencing the same thing, and I'm not enjoying the lecture at all, honestly.
Okay, Ben, it's quite unfortunate. And sometimes when it happens like this, because we are the closest to you, we happen to incur the anger from you. But it is not our fault. Me, I'm a lecturer. I'm not a university manager.
I know, because at the moment, even I'm inside the Feld building.
You are inside what? Feld?
I'm here on UCC campus at the Feld.
But the network is still bad.
Sometimes you go off and I can't hear anything.
It's quite unfortunate. It's not because of Meme's side. Here, right now, where I am, I'm not even in my personal office. Because sometimes the internet in my personal office can get a little weaker. Because I want to give the best to my students, I have moved to a different place, our server room, where the internet is the strongest. But if the connecting ends, if your internet is weaker, you will have the problem you are having. You can get the full benefit of the class if you have a good internet. So now some burden is falling on you. I remember last week, one lady, I think she even belongs to this class. She called, and from the way she was speaking, I thought the best way to help her was to make her come. So she came to the office, and the problem was internet. She is using a modem which operates on the 3G platform. The 3G platform internet has now become very weak. So you will get breaks in the connection, on and off. And this is a heavy transmission, video. So it will not be able to carry it the way it should. So what I advise is that you should go to MTN office and inquire whether it is the device itself which is configured 3G or the chip. If it is the chip, then you can take the chip away for them to give her a 4G equivalent so that you can get a faster internet. So it can be that the network you are on is a lower level network and the speed or the strength of the internet is not strong. In that case, wherever you are, whether you are on campus or you are home or you are traveling, it will give you similar problems. It will give you similar problems. And it is unfortunate and it's nobody's fault. Not all of you can go and buy the 4G, the so-called TurboNet from internet and other things from Vodafone. Those who have those devices, they have never had that problem because they can give some good level of internet strength. But the normal internet is quite weaker and you will get those problems. Sometimes you may not even be able to see the screen because the transmission is not strong to carry the video images for you to see. So some people report, say, my screen is blank, it's dark. The internet cannot carry that heavy packet, video packet, it cannot. So senior, it's not my fault. I am doing my best. My side here, everything is okay. If you have any anger, please channel it to the investing management. They should have done the implementation correct. As for me, I am just operating on the instructions they are giving me. I should teach on this mode. And I've done my best to give the best to my students.
Thank you.
Okay. So that is where we end the lectures on financial statement preparation, financial statement analysis. Today, how many minutes do I have left? I may just have to introduce the next topic. Then we will finish it the next day, tomorrow.
So you have 20 minutes left.
20 minutes.
20 minutes.
Great.
Less than 20 minutes.
Hey, the one saying less than 20 minutes. Are you in a hurry to leave?
That said, today's lecture, if you even pause here,
okay, so
I for one, I'll be happy because the content is loaded.
Okay, so can we keep quiet?
Yes, sir.
And then let's introduce the topic for today. In fact, what we have done belongs to last week. Last week, and it is because it's not because I don't teach faster. It's because my class, my students are very good students. They will engage you, the lecturer. They will ask questions for clarification. So that thing ends up taking more time. So I'm not just lecturing. The way you participate in the class is forcing me to teach. There's a difference between teaching and lecturing. I'm actually teaching, and teaching takes more time than lecturing. So let's do the topic for today. Cost, volume, profit, into bracket CVP, analysis. CVP analysis. It's a short-term profitability analysis. It is not applicable for the long term, short term. We want to know what these two, remember the program, and for that matter, this course, particularly accounting and finance for managers, is to equip you with business analytic tools to help you become good managers at your job places, take good decisions, and grow your businesses. So all the things you have done so far are tools building. So you have added something in your toolkit now. Financial statement preparation, financial statement analysis. It should be part of your tools in your toolkit. Now we are going to do cost, volume, profit analysis. When we set up a company, we want to assess, sometimes even before setting up the company, we want to do research, some market research, and assess based on that research how profitable the company is likely to be. So we will want to know, given the revenue that this company or this product we are selling can bring, revenue per product, selling price per product, given the cost per the product and other costs, how many of the products do we have to sell to make certain amount of profit? Basically, that is the level of analysis we are going to do. We know how much we can sell this product for. We know how much it takes to produce this product. We know some other costs that we will incur for going into this business. Given all this information, we can calculate ahead of time how many of the products that we have to sell to generate certain levels of profit. And that guides our decision making. That is the whole idea behind cost volume profit analysis. Relationship between the cost of the product, the revenue from the product, the amount you have to sell of the product, how these variables relate to themselves, just like I've explained before. Now let's see. I think to teach this topic very well, we have to go back to one other topic before it can help. I was going to assume you have that knowledge. In fact, that is what it is. You should have had that knowledge, but it might surprise me most of you wouldn't have it. It is called marginal costing. All of you have done marginal costing before, so you know the principles inside marginal costing, right? You all understand the principles within marginal costing, is that correct?
No, sir. No, sir.
Okay.
Not everything. Some of us are new to these courses.
Okay, so let me be brief with marginal costing. And I'll tackle on the part of marginal costing that we will need to understand the cost volume profit analysis. Marginal costing focuses much on the costs that vary with respect to the activity we are doing. So if you are producing a product, the costs that vary with the level of production. Marginal costing concentrates much on that. Costs that are not fixed, marginal costing perspective says costs that are not fixed, costs that are fixed, costs that do not vary, is not too useful for decision making, because whether you produce or you don't produce, that cost will be the same as it is. But the costs that increase as you produce more, decrease as you produce less, those are the costs that matter when it comes to making decisions about production. So that is the basic ideology behind marginal costing. So in marginal costing, what goes into a product cost, they think should be only the variable cost of producing the product. And variable costs, we know most of them. The raw material that we will use in producing the product is a direct cost and it's a variable cost. If you produce one of the products, it will consume certain amount of raw material. If you increase the production to 2, the amount of raw material increases. If you increase it to 1,000, it increases in that fashion. So it is a variable cost. So raw material cost will be part of please, excuse me, I'm coming. Hello. Yeah, what's coming here? Sorry for that. So variable costing concentrates on only the variable cost. So apart from raw materials, we may have direct labor. The person or the people who will be converting the raw materials into, so direct labor costs, raw material costs. Their cost is variable. If you are producing more, it means this labor will spend more time and labor is paid on time basis, it means the more we produce, the more cost for labor. It might even come in the form of the more we produce, the more labor we have to hire. That means the more labor cost. So direct labor cost is a variable cost. Then we have variable overheads. There are some costs that are not direct to the product, like the raw material that you can even identify with the product. There are some costs that are not like that. They are not identifiable with the product, but they also vary as we produce more. For example, factory supervisor's cost. The factory supervisor will not be part of, let's say we are producing tables. You can't find factory supervisor with a table, even though you can find the wood, the metals that go into the building of the table. The factory supervisor is not identifiable with the table, but the factory supervisor's costs tend to move along with the level of production. His supervision is normally paid on a supervision time basis. So the more we produce, the more supervision and the more supervisory cost, making it a variable cost, variable to the level of production. But that.
Hello, sir.
Hello?
Hello, sir.
Yes, madam.
Please, I can't figure out your writings well.
Okay, I'll write well. Thank you very much. I was becoming a bad teacher.
Thank you.
Sir.
So direct.
Hello, sir.
Yes.
The factory supervisor's role, can it not be found in the labor cost?
You see, we normally separate them. The factory supervisor is different from the person who is holding the hammer and the sandpaper and making the table. The supervisor is not doing the actual production of the table, but the supervisor is at the factory door supervising them. So there are two different costs. The direct labor cost is very close to the product. The factory supervisor is a little bit remote from the product. So there's a difference, and in costing we separate the two. So direct material cost is a variable cost. Direct labor cost. It's also a variable cost. Then variable production overheads. Variable overheads. Overheads, let me write it in full. Variable overheads are those non-direct costs which also vary in response to the variations in the activity level. The question will give you this information. So all of these things is what marginal costing people say should form the cost of the product. So let's call it variable cost of the product. Because there is an opposing school of thought called absorption costing, which try to dispute this kind of belief from a certain angle, but we are not interested in absorption costing for now. So this is the cost of the product. Then, if we have the selling price of the product, the selling price minus the variable cost of the product give us what marginal costing people call contribution. Contribution. So contribution is equal to selling price minus variable cost. And they call it contribution because at this level of computation, if you subtract your sales revenue, so this is the aggregate figures, sales revenue, the selling price is for 1, so we are talking about the total sales revenue from your total variable cost. You have only covered your variable costs. Your fixed costs are not covered yet. But whatever profit that we call contribution, that you will get from subtracting only your variable cost from your sales revenue, that profit is a profit to contribute towards the recovery of your fixed cost. That is why they call it contribution. So contribution towards fixed cost. So those are the terms that you have to know. And I think basically this is what you need to know about marginal costing that will help us understand our...
Sir, please, can you go over the contribution, the last part?
Contribution is equal to... In fact, we can calculate contribution at unit level. So contribution... Let me do it well. Contribution per unit. That is contribution on one product. So if it is tables we are producing on one table, so contribution per unit is calculated as selling price per unit minus variable cost per unit. We can also calculate contribution at the aggregate level. So total contribution is equal to sales revenue or revenue. That is the total revenue minus total variable cost. They all mean the same thing, just that way this one we have computed it using 1 unit of the product. This is the total unit of the product. And I said it is called contribution because if you subtract total variable cost from your sales revenue, what you will get is some measure of profit. But it is a measure of profit without consideration of fixed costs. But this is only variable cost. We have not subtracted our fixed costs yet. So whatever profit that will be remaining, that is the profit we call contribution. And we call it contribution because that profit is now going to contribute towards the recovery of fixed costs. Fixed costs are yet to be dealt with, to be subtracted. So that's where the name comes from. Contribution. The name contribution comes from. Is that correct? Is that okay?
Yes. Thank you, sir.
Okay, so I think it is time. So what I will do is that if you go to your book, the topic on cost volume profit analysis, the book I sold to you, almost all the copies are with Raymond. Raymond has made fantastic arrangements. Some of you have already had your copies via some medium. Try to get the book, or if it is not possible, I think just next week you are coming. And Raymond is coming with any remaining amount of the books. So you make ready to grab your copies. Chapter 10 of the book treats this topic fantastically.
Okay.
Chapter 10 of the book. I think chapter 9, I've not checked, but check chapter 9 or look at the table of content and look for the topic on marginal costing. So you can sharpen your understanding of the marginal costing principles on which the cost volume profit analysis is built. All right?
Hello, sir.
Yes, madam.
What about those who are on campus? How do we get it? Some of us are already on campus.
Some of you on campus, they have seen me to take copies from me already. So those on campus, yet to take copies, the arrangement was that Raymond will come with the books with him. But it appears that the number of books with Raymond will still not be enough. And what it will mean is that those on campus for now, if you can see yourselves, those on campus without the book, then I get to know the book. Then I tell the producer to make just those numbers for me. The reason is that the book is under revision. So if I make copies and they don't get sold out, the remaining amount will be redundant and it will be an unnecessary cost. So if I get to know, okay, maybe 10 more copies need to be made, I'll go and beg the guy to make just 10 and then I distribute it. So it will depend.
So how much is one?
It's just 45 cedis.
Okay.
In fact, it was 50 cedis, but because of the struggles involved, blah blah blah, so I slashed the 5 cedis off. So that maybe the means to get the book to you, especially because Raymond was using those means to get to you, it can meet you some way through your cost. So that is it. So find the chapter on marginal costing. Read to solidify your understanding in the principles that we'll need, and then chapter 10 is on cost volume profit analysis. So you can read ahead of time. When we meet tomorrow, we have to finish the whole of that topic tomorrow. Frankly speaking, let me be straightforward. That topic is in two parts. We have an analysis of cost volume profit analysis for single product environment. We assume that the company produces only one product. And in most cases, companies produce more than one. Look at Coca-Cola. They produce Coke, they produce Sprite, they produce Guinness, they produce Alvaro, they produce Origin, a lot of products. So if you are assessing if you are doing cost volume profit analysis in such multi-product environment, what would it be like? So we'll do the single product environment and the multiple product environment, and it's most likely that you get a question on both. So take all of them seriously. Okay, so that is it. If I don't have any question, this is where we may depart.
Hey, hello, sir.
Yes, sir.
My line went off, so I didn't hear what you said last week.
Okay, what I said last was that the cost volume profit analysis, we will do it on two levels. Single product environment level, and that is completely in your book. Then multi-product environment level, I may have to supplement what is in your book with additional notes. So I'll do that note and give it to you. So you can start your reading from chapter 10 of the textbook.
Okay.
Is that okay?
Yes, sir.
Okay.
The marginal costing is on chapter 9.
It's chapter 9, yes. I arranged the book in such a way that because we will need the principles in marginal costing for the CVP, so I made it follow immediately. So,
Where are you going to?
Hello?
You don't have. Sir.
Yes, madam.
You get what? I'll get what?
Hello, I can't hear you.
I said if I need one right now, I will get it.
If you come right now, I think I can get you one. I gave one to Mr. Cowell. So I can take that copy and give it to you and later give a copy to Mr. Cowell.
Okay. But where can I?
I will be in my office. You know where School of Business is?
Yes.
Do you know where School of Business offices are?
Yes.
That's where I'll be. Please do well to call me if you are coming around.
Please, I don't have the number.
Hello?
Can I get the number?
Yes. 050
050
660
284
95. That's my number.
050 688 495.
Yes.
Okay.
Okay. So please, the assignment. Please try to tackle them bit by bit. If you wait till it is a day before the deadline, that's where you see it to be, oh, this is difficult, this is difficult. If every day you take your book, even one ratio, you take your textbook, you read about that ratio, oh, okay, then you look at the figures. You can easily compute all of them within few days. And then when it comes to reading on the interpretation, internet is there, so many sources of information. You can read and expand your knowledge. You have to remember that we are doing all the things we are doing for knowledge's sake. It's not for A or B or C. That is useless. Okay, thank you.
Thank you, sir.